A very warm welcome to all. Thornton is delighted to share the findings of the International Business Report 2013 on mergers and acquisitions. Today's webcast will be addressed by Munesh Khanna, Partner Corporate Finance, who will take us through the findings of the IBR M&A report. We also have Raja Lahiri, Partner Transaction Advisory Services, who will be speaking on a cross-border scenario in India. I would like to share a brief background on our eminent speakers who are based out of the Thornton office in Mumbai. Munesh is a senior partner with the firm and has over 27 years of experience in corporate finance advisory, tax, regulatory, and capital markets. He offers experience in providing corporate finance and tax and regulatory advisory solutions across manufacturing and service industries, particularly real estate, energy, telecom, infrastructure, banking and financial services, as well as the FMCG sector. Now to brief you a bit about, on Raja Lahiri. Raja Lahiri is a partner for Transaction Advisory Services who has rich experience of over 15 years in advising clients on post-deal integration matters and ideation of exits for private equity funds. He focuses on various aspects of the deal making, starting from deal origination, ideation, preliminary deal analysis, due diligence, valuation, deal negotiation, and advises on deal agreements. His role in the firm also includes leveraging on his wide range of experience in a number of sectors such as technology, media, and financial services. Over the years, Raja has led and advised more than 250 deals and has advised private equity, venture capital funds, corporates on various occasions. Please note, all Q&As will be addressed via chat. Alternatively, you could write to us on contact@in.gt.com. I now hand it over to Munesh to take you through the findings of the survey.
Good day, ladies and gentlemen. On behalf of Thornton, it's my pleasure to present this year's International Business Report. When reflecting on the results from this year's IBR, the International Business Report, one has to take into account the major political and economic events that have dominated the global agenda over the past 12 months. With the ongoing Eurozone negotiations, the US fiscal cliff, the continuing Arab Spring, and the various domestic elections, including those which we had in France, the US which just completed, looking forward to elections in India, it is understandable that many business leaders surveyed by us remain cautious about their current and future commitment to mergers and acquisitions. However, what is encouraging from this year's results is the increased appetite of companies for cross-border acquisitions, which is at its highest level since the IBR first asked this question in 2008. This trend underlines that this domain, the cross-border acquisitions mergers domain, previously dominated by large corporates, is progressively becoming a focus area for businesses of all sizes, whether they are acquiring or indeed looking to source potential acquirers for their own businesses. Accessing global customers, relationships, and new markets may well now be the most important strategic tool for companies seeking to grow, especially as many continue to experience either limited growth domestically or are operating in highly competitive, saturated domestic markets. To give you an overview, the Thornton IBR is a quarterly survey of 3,500 executives, both in listed as well as privately held businesses all over the world. This was launched in 1992 in 9 European countries, but the report now surveys 13,000 business leaders in 44 economies on an annual basis, providing insights on the economic and commercial issues affecting global companies globally. The data in this report is drawn from more than 12,000 interviews with business leaders conducted between the calendar year 2012, January to December 2012. The report this year focuses on the increased interest in cross-border M&A activity, the regional highlights of interest in M&A activity both domestically and cross-border, A few comments on how the firms will be financing this growth or are expecting to finance this growth, and the current exit perceptions within the business leaders and the business community. The overall finding by us was that the cross-border deals are set to rise. The global expectation is that the cross-border deals will drive acquisitive growth, and this has increased by over 50% from 2008 and 18% in the last year alone. We must take into account the background that 2008 was, in fact, we are coming up from a very low base. But there is a continuous increase in this expectations. Whilst overall the survey results indicate that some of these businesses may be holding back on committing to acquisitions in the next 3 years, there is no doubt that many of those that will be considering an acquisition, and they will be looking overseas to facilitate this growth. In India, the results illustrate the ground realities, that the recent economic slowdown and political and economic issues are still to be resolved, and they do appear to be impacting on where businesses seek acquisitions. And therefore, there is a greater focus again on overseas opportunities. The expectations from the mergers and acquisition activity. The result shows that 28% of the businesses across the globe expect to be participating in M&A activity in the next 3 years. In India, it is slightly lower, with 25% of the Indian businesses plan to grow the acquisitive way in the next 3 years. So clearly indicating the trend that India is more cautious at this point of time. Overall, the BRIC region respondents continue to be very enthusiastic, but what we have seen is that their responses are now more aligned with the rest of the world, with everyone being there on the 27 to 28% expectation. The respondents also revealed that across the globe, that they expect their acquisitive growth to be cross-border rather than domestic, rather than being within their economies. And again, different countries are showing different results, but economies which are doing very, very well globally, Singapore, the UAE continue to show more than 60%. In Singapore, it's more than 80% of the respondents said that they would be expecting acquisitive growth cross-border. The percentages again remain high in Europe, and in India and the United States. In India, 46% of the respondents indicated that they would be looking at cross-border opportunities, and the result is more or less the same in the US, also looking outward. The other key issue that we focused on was how do these respondents expect to finance the M&A growth. Whilst M&A remains a key growth strategy, the ability to finance such growth in the current financing market is potentially impacting the residents' view on the likelihood of transactions in the short run. Specifically, when asked that how do the respondents expect to finance their growth strategy, it was noticed that bank finance has slipped from 53% in the last year to 48%. It continues to be a large chunk, next only to retained earnings, but more and more importance is also being paid to equity. Both private equity and public market options are what respondents are looking at, of raising more equity to fund these M&A activities. The factors which drive growth through acquisition remain similar from year to year. It is to build scale, it is to acquire new technology or establish brands, and there is a sizable importance given by Indian companies to acquire brands, access to geographical markets, to new geographic markets, expanding operations, and in some cases access to lower cost operations. So the thrust continues to be expanding market rather than focusing on the cost. However, when asked, how many businesses in India, globally or in India or in BRIC are likely to sell their businesses and are likely to be change of ownerships, there we found that only about 8% of the businesses foresee an exit over the next 3 years. And this really is coming in from the fact that given the slightly depressed market conditions, people are concerned about valuations, whether they would be able to harvest and maximize the value for their businesses, and therefore they are at this point of time loath to selling out or changing on their ownerships. So with a summary, what I'd like to say is that we've had a very turbulent 2012, but hopefully it is behind us. 2012 saw significant political and economic decisions were made, and many of these key decisions and policies have been set in 2013, not least in US, Europe, India, and Japan. And therefore, it is not unsurprising that the businesses are cautious. M&A remains a key strategic tool for businesses across the globe to drive growth and build scale across the world. And the marked increase, what we are seeing is that there is a marked significant increase in prominence and importance of cross-border acquisitions, M&A activity, which rather than domestic, which illustrates that accessing global markets and opportunities is now more than ever a vital growth strategy. With this, I'd like to invite my partner, Raja Lahiri, to speak on the transactions in India from an India perspective.
Thanks, Munish, for kind of sharing and giving your views from a global perspective. As far as I'm concerned, I'm going to kind of walk you through in terms of the cross-border trends in India. And I think the data that we've kind of gathered, which we do on a monthly basis, is the Grant Thornton Deal Tracker. This Deal Tracker basically captures all the publicly announced transactions, both in M&A as well as in private equity. The key focus for this presentation is on cross-border as far as India is concerned. So if you look at the data perspective, we've kind of divided the cross-border activity into two parts, which is the inbound transactions and the outbound transactions. When one looks at inbound transactions, as Munish rightly said and mentioned, that clearly 2012 has seen, from a global crisis perspective, the Eurozone crisis, the Arab Spring issues, as well as from an India perspective, we saw two key drivers. One is the growth slowing down, and the second is clearly the budget and the tax uncertainty issues that the economy saw in 2012. From that perspective, if one looks at the total deal activity, 2012 saw total inbound deals of $7 billion, which is significantly down from 2011, which had $29 billion of transactions. So that clearly indicates a significant impact on the inbound deals in 2012. In 2011, we saw three large deals. One was the British Petroleum Reliance Industries deal of $7 billion for a minority stake in Reliance. We also saw two large international M&A and restructuring deals, like the Vedanta Kane, which was a $9 billion deal, as well as Siemens AG and Siemens India Limited, Siemens AG picking up a stake to 75% of around $1 billion. We clearly saw some of these larger deals not happening in 2012 and clearly impacted the total deal activity in 2012. As far as outbound deal activity goes, clearly our data and research shows that 2012 indeed had $14 billion of deals, which was actually more than 2011, which had $11 billion. However, the 2012 outbound deal activity was indeed much lower than 2010, which had $22 billion of deals. I guess the critical thing to note is that, as I said, the inbound deal activity clearly had a knockdown, whereas 2012, the outbound deal activity actually showed an increase, largely on the back of oil and gas sector, which saw 2 to 3 large cross-border deal activity, where Indian companies bought oil and gas assets in the Russian region. Now walking to the top inbound deals, again this data is from our Graham Thornton deal tracker. If one focuses on the key sectors that drove deal activity in 2012, we saw the consumer sector where Diageo kind of acquired United Spirits, a majority stake for a $2 billion, clearly the largest deal in 2012. The other interesting deal was in the sector of insurance, where Sumitomo Insurance of Japan, Mitsui Sumitomo, bought a significant stake in Max New York Life of $0.5 billion. And as always, pharmaceuticals have always remained to be a very interesting sector as far as India inbound deal goes, where Watson Pharmaceuticals bought Ascent Pharma Health for $0.3 billion. As far as 2013 goes, which is from Jan to Feb, we already saw Mylan from the US picking up Agila Specialties, which is a group company of $1.8 billion. So clearly pharmaceuticals remains to be a pretty important sector from inbound deal activity. Going forward, as far as outbound deal goes, I guess in the last 3 years, one of the biggest deals was the Bharti Airtel chain transaction in Africa for $10 billion. Clearly that impacted and showed up the deal values in 2010. And as I said, in 2012, if one looks at the top 3 deals, these are all in the oil and gas sector, acquirers being ONGC, Gulf Oil, and ONGC Videsh, picking up assets in the US and Russia. As far as 2011 goes, we saw clearly GVK doing a coal transaction, coal mining asset acquisition in Australia of Hancock Group for $1.2 billion, clearly indicating the kind of deal activity in the coal mining and the resources space. As far as the industry sector goes, and when we've analyzed the deal activity as far as India is concerned by sectors, if one looks at inbound, the biggest sector has been oil and gas at 35%, followed by pharma at 19%, then telecom at 12%, BFSI at 5%, then breweries and distilleries at 4%, and then IT/ITES at 4%. So clearly, oil and gas, as I indicated, remains the top sector as far as inbound deal goes, driven back of the 2 large deals as I mentioned, which is the BP deal in Reliance and the Vedanta Kane transaction, which clearly impacted the deal values. From an outbound sector perspective, we've obviously seen deal activity in most sectors. Clearly in the last 3 years, 2010 onwards, the largest being in telecom at 24%, largely driven by the Bharti Zen deal, and then followed by oil and gas at 14%, mining at 9%, pharma at 7%, and IT/ITES at 6%, and then followed by metals at 6%. So clearly, again, while there are outbound deals in all sectors, we see again oil and gas hopping around to be the second largest sector with the highest deal value. From a country perspective, what we've analyzed is when one looks at the various countries, the key countries, looking at deals from a cross-border perspective as India is concerned, interesting to note is UK comes out to be the top destination where the maximum cross-border activity has happened as far as India is concerned. In terms of inbound deals, there were $24 billion that came from UK, followed by US at $8.6 billion, and then finally we had Japan at $4.4 billion from an inbound perspective. As far as outbound goes, clearly the top two destinations are US and UK, and clearly as far as Indian companies are concerned, US and Europe remain to be the top destinations. The point to note is UK and US have always dominated cross-border activity. However, what we are seeing is a significant heightened interest in deal making from Japan. I guess the strength of the yen as well as the shrinking domestic market in Japan clearly is making Japan to take significant interest in India. And Japan, we have seen large deals coming in the steel sector, in the insurance sector, in the IT/ITS sector, and from our perspective, in my view, we will see Japan to be a stronger country as far as deal making is concerned. As far as UK is concerned, we had $24 billion of deals, clearly the largest being the Vedanta and the BP deal, followed by Diageo deal as far as inbound is concerned. As far as US is concerned, we had the Abbott Piramal deal of $3.7 billion, which was a large inbound transaction in the pharma space, then followed by Gulf Oil and Aditya Birla buying a chemical company in the US. As far as Germany is concerned, we saw Siemens AG buying out the stake in Siemens India, basically increasing the stake of $1 billion, which showed up the deal values from Germany. In our view, as far as India is concerned, there are 3 or 4 takeaways that I want to set on the table. One, 2012, we've clearly seen decline as far as inbound activity is concerned, as I mentioned. However, the outbound deal activity has actually increased on the back of the deals in the oil and gas space. In our view, however, the current regulatory changes in retail, aviation, and broadcasting, we expect the deals, especially the inbound deals, to increase in some of these sectors. We also feel that the uncertainty type issues as far as the GAR and the budget type issues which were there in 2012 possibly have, these issues will not be seen this year given the statements from the government as well as the new regulatory regime differing GAR and things like that, which would bring certainty as far as cross-border deal making is concerned. What we also believe is that from a private equity perspective, there are a significant number of investments that went through in 2007-8 as far as India was concerned, and we see exit opportunities clearly defining and setting the tone for a very ripe M&A market for India. We also see sectors like IT/ITES, telecom, as well as banking financial services sectors to clearly see increase in deal activity in 2013. As far as overall outlook is concerned, in India, from Grant Thornton perspective, given the landscape, we believe that 2013 would see a good amount of deal momentum. However, with a little bit of caution, given some of the India issues and some of the global issues that we talked about. With this, I kind of end my kind of presentation on the cross-border deal activity in India, and happy to kind of take questions if you have via chat.
Thank you for being a part of the webcast. In case you have any questions, do feel free to write to us on contact@in.gt.com or drop us your queries via chat, and we'll have our experts answer it for you. Thank you.